macro currency signals.
Many investors ask, when should I sell my gold and silver? Especially now, with prices swinging and the monetary order feeling shaky, the temptation to chase highs or panic sell lows is real. But smart selling isn't about guessing a top. It's about following signals, understanding risk, and setting clear rules before emotions take over. When it comes to precious metals investing, especially gold and silver, the first rule of selling isn't about timing the market's every twist and turn. It's about clarity of purpose. Too many investors ask, what price must gold or silver hit before I sell? Without first asking themselves the more important question, why did I buy them in the first place? The smartest decisions happen when you set your targets before price noise and headlines start screaming at you. Before we go any further, if this breakdown is resonating, make sure you're subscribed and notifications are on. Staying early matters in moments like this. Drop a comment below and tell me where you're tuning in from and what time it is on your side of the world. This conversation is global, and it's always powerful to see how wide the reach really is. Now, let's come back to what just happened. Let's ground this idea in today's market reality. As of the latest data, gold is trading near roughly $4,150 to $5,000 per ounce in global spot markets, and has been bouncing around this range amid bouts of volatility. Meanwhile, silver is trading in the low 80s per ounce, after strong rallies and sharp sell-offs that reflect both industrial demand speculation and safe haven flows. That context matters, because if you bought gold at $3,000 an ounce or silver at $40 an ounce, you're sitting on big gains. But does a headline figure, even one that looks like a massive round number, automatically mean you should sell? Not necessarily. This is where your investment goals take center stage. Before you ever clicked buy, you should have asked yourself, what's my profit target? When have I achieved what I wanted from this trade? Is this a short-term swing or a long-term hedge? If your goal was a 20% return on cost, and gold or silver has hit that threshold, then part of your position should be sold. Not because of fear, but because your plan has been fulfilled. Locking in profits this way preserves gains rather than letting greed push you to hold for a mythical top. This isn't just theoretical. When gold was breaking records above $5,000 per ounce earlier this year, many seasoned investors who had preset profit triggers began trimming positions, reallocating to cash or other assets, and reducing risk exposure. Likewise in silver, where prices have been known to surge and then reverse sharply within days, those who defined exit points early avoided emotional selling at the worst moments. Consider your time horizon as well. If you're a long-term position holder, buying precious metals as insurance against inflation, currency debasement, or systemic risk, your selling trigger might not be a price at all, but rather a change in the fundamental story you're betting on. That could be a major shift in monetary policy, real yields spiking back into positive territory, or geopolitical tensions easing dramatically. On the other hand, if you're a tactical trader looking for short to medium-term gains, then defined profit targets and partial profit taking are essential. You don't dump your entire stack at the first sign of a move, but you do take profit systematically. Sell a portion when your first target is hit, move your stop loss up, and let the rest run with discipline. So the takeaway, sell because your goals were met, not because the price feels high. That mindset transforms selling from an emotional reaction into a strategic decision. When we talk about selling gold and silver, signal-based selling is where discipline beats emotion every single time. You don't sell because of fear, greed, or a random headline. You sell because the market has given you clear, actionable signals that the conditions you originally invested under are changing. Right now, gold continues to hover near the $4,900, $5,000 per ounce range on the global spot market, and silver is trading around the $82, $90 per ounce band, depending on the feed you follow. Those price numbers are important, but they're just numbers. By themselves, they don't tell you why you should sell. Signals are different. Signals are the patterns, fundamentals, sentiment shifts, macroeconomic data, and rate and liquidity dynamics that give those prices meaning. Let's start with monetary policy signals. Precious metals don't yield interest. When real interest rates, that is, interest rates after inflation, drift higher, gold and silver tend to lose their allure because cash and bonds suddenly pay something, making non-yielding assets less attractive. If you see a sustained move in real yields upward, for example, persistent strong jobs numbers, a hawkish central bank tone, or higher than expected inflation data that forces rate hikes, these are signals that could justify trimming metal positions, even if nominal prices appear high. Conversely, when the market begins to price in rate cuts or a dovish pivot by a major central bank, gold and silver prices often jump as investors seek stores of value. We've seen that in recent sessions as some economic data has weakened and rate cut expectations have increased, nudging gold and silver higher. But short-lived spikes alone are not reliable sell signals. They're noise until they are confirmed by the broader macro narrative. Another critical signal is volatility and market leadership shifts. If equities or risk assets suddenly regain strength and money rotates out of havens into growth assets, that shift can be a leading indicator that safe haven demand is fading. In such environments, even if gold is trading at near record levels, you would consider reducing exposure because the underlying demand signal has reversed. You also want to watch momentum and technical breadth signals, not just the price itself. If gold rallies to, say, $5,120 per ounce but starts showing weakening momentum, lower highs on shorter time frames, or divergent indicators on volume and volatility, these are technical red flags that momentum is drying up. Similarly, silver's swings have historically been sharper than gold's, so a breakdown of key support levels amid declining volume is a sign to tighten risk or take profits, rather than waiting for a round number. And then there's real macro discontinuity signals. Things like geopolitical escalations, trade disruptions, or systemic financial stress. These events can suddenly re-rate gold and silver from boring commodities into critical hedges, and the absence of these risks when pricing and premiums means it might be time to take profit. So in short, don't chase price targets, chase signals. The market always whispers before it screams. Selling based on fundamental and technical signals gives you the precision and discipline that emotional selling never can. One of the biggest mistakes investors make with gold and silver is selling because they're scared, instead of selling because their portfolio's structure has objectively changed. Today, gold is trading around $4,900 to $5,000 per ounce in global spot markets, and silver sits in the low to mid 80s per ounce, sometimes creeping toward $90 on stronger sessions. These are significant levels, but prices alone shouldn't trigger emotion. They should trigger reasoned action. The heart of smart selling isn't fear or greed. It's rebalancing. Rebalancing means measuring where your portfolio actually is versus where you intended it to be. When you bought gold and silver, you likely did so with specific allocations in mind. 5%, 10%, maybe 15% of total assets dedicated to hard assets or inflation hedges. Those percentages aren't arbitrary. They reflect your risk tolerance, time horizon, and investment thesis. When gold and silver prices surge, as they have in recent months, those allocations can easily balloon beyond your plan. For example, imagine you started with a portfolio that had 10% in gold and 5% in silver. A strong bull run pushes those positions to 18% and 9% respectively. At that point, the risk profile of your portfolio has changed even if nothing else in the market has. Your exposure to precious metals is now almost double what you intended. That's when rebalancing becomes a sell signal, not because you're afraid of a drop, but because you're restoring your portfolio to the risk level you're comfortable with. Rebalancing is especially important in markets like precious metals, where prices can be driven by short-term sentiment, macro noise, or speculator flows. When gold breaks key psychological levels, like the area above $5,000 per ounce, it draws attention, headlines, and momentum trades. But that doesn't automatically mean your long-term thesis has changed. It simply means prices moved. Rebalancing gives you a disciplined way to capture gains without losing your strategic edge. Likewise with silver, whose price swings tend to be more volatile. Silver can jump rapidly on industrial demand optimism, hedge fund positioning, or shifts in global liquidity. But that same volatility means silver can give back gains just as quickly. If your portfolio suddenly has a disproportionate share of silver because of a rally into the $80-$90 range, rebalancing back toward your target allocation is a rational move. You're not abandoning your metals strategy. You're managing risk. Rebalancing also protects your emotional psychology. Panic selling usually happens when the market is falling and fear is at its peak. But rebalancing sells into strength, calm, calculated, and consistent with your original objectives. It's a proactive move, not a reactive one. The idea isn't to never sell when prices go up. It's to sell when your portfolio signals that it's time, based on rules you set ahead of time rather than gut reactions. That's how disciplined investors protect gains and keep their long-term strategies intact. When you're thinking about selling gold and silver, one of the most powerful tools in your investment toolkit isn't a single price. It's the relationship between the two metals. This is what we call the gold to silver ratio, and it's a signal that tells you not only where prices are, but where value might be hiding. Before we dive deeper, let's anchor ourselves in today's market. Spot gold is trading around roughly $4,160, $5,040 per ounce on the international markets, with silver sitting in the low to mid 80s per ounce range. At first glance, those numbers might seem like just prices, but when you look at the ratio, you get context. The gold to silver ratio is simply the price of gold divided by the price of silver. So if gold is $5,000 and silver is $80, the ratio is around 62.5 to 1. That means it takes roughly 62.5 ounces of silver to equal the value of 1 ounce of gold. Changes in this ratio over time tell you how the market values each metal relative to the other. Why does this matter for selling? Because gold and silver don't move in lockstep. Gold is more of a pure store of value, a hedge against systemic risk, inflation, and currency debasement. Silver, on the other hand, wears two hats. It's both a store of value and an industrial metal used in electronics, solar panels, EVs, and medical applications. That dual role makes silver more volatile and often more sensitive to economic growth expectations and industrial demand. That's where the ratio becomes your compass. A high gold to silver ratio, one that's significantly above historical averages, suggests silver is relatively cheap compared to gold. In those conditions, you might consider holding silver longer and even trimming some gold, because the market seems to undervalue silver relative to gold. Conversely, a low ratio means silver is relatively expensive, potentially a signal to take profits in silver and let your gold position ride, especially if your gold thesis remains intact. For example, if you bought gold at around $3,000 an ounce and silver at $30 an ounce, and now those positions are $5,000 and $80 respectively, your gains are positive in both. But the ratio tells you silver's gain has not kept up with gold's rise on a relative basis. That could indicate that silver has more catch-up potential if industrial demand picks back up or safe haven demand broadens. On the other hand, if silver suddenly spikes toward parity with gold gains and the ratio compresses dramatically, that could be a signal to take profits in silver first. Importantly, the ratio helps you think in terms of relative value, not just absolute price levels. A gold price of $5,000 might sound high, but if silver is lagging and the ratio is stretched, maybe gold is the better sell candidate right now. Or if silver has outperformed and the ratio has compressed below long-run averages, it could make sense to lighten silver exposure and rebalance toward gold or other assets. So instead of fixating on round price targets, let the ratio guide you. It's a dynamic, market-driven measure of relative value that helps you sell smarter, not just louder. When it comes to deciding when to sell your gold and silver, one of the most overlooked insights is this: real-world triggers matter far more than round price numbers or hype-driven chatter. Yes, gold is currently trading around roughly $4,900, $5,000 per ounce, and silver is sitting in the low to mid 80s per ounce range on global markets. But price alone doesn't tell the full story. It's why prices are moving that should drive your decisions. Let's break that down. Gold and silver are beloved not simply because they're shiny, but because they serve real economic functions, preserving purchasing power, hedging against monetary instability, balancing portfolios, and, in silver's case, serving industrial demand. These functions don't vanish just because the price ticks up. They only change when the underlying real-world conditions shift. Imagine you bought gold as a hedge against inflation and weakening currencies. Then imagine inflation actually starts easing, central banks tighten further, and currencies strengthen, even as gold temporarily rallies on speculation. The rally feels good in your account, but if the reason you bought gold in the first place is no longer present, that's a real-world trigger to consider reducing your position. In other words, you sell because the original rationale has changed, not because the price crossed an arbitrary threshold. It works the same in reverse. Suppose you own silver partly because you believe industrial demand will accelerate, demand from clean energy tech, electronics, and automation. If data comes out showing a steep contraction in those industries that isn't noise, that's a real economic shift that can justify selling some or all of your silver, even if prices are still elevated relative to where you bought. We see this play out in markets all the time. Prices can rally on hope, speculation, or headlines, but long-lasting moves are driven by real fundamentals: monetary policy, supply disruptions, demand cycles, geopolitical flashpoints, or structural economic trends. These are the triggers that matter. Gold's climb toward and around the $5,000 mark didn't happen in a vacuum. It reflected anxiety over inflation, currency instability, and geopolitical risk. Conversely, if those drivers start to fade or reverse, that's your cue, not the dollar figure itself. Real-world triggers also include personal financial events. Maybe you need liquidity to fund a major purchase, invest in your business, or pay down high-cost debt. These personal triggers are just as valid because your financial life isn't theoretical. It's real. Selling a portion of your gold or silver to meet a defined need can be the right move, even if prices don't look like they're at tops on a chart. Another example, geopolitical risk can quickly elevate precious metals. A military escalation, a debt crisis in a major economy, or systemic bank stress can send gold and silver higher as investors seek safety. But once that trigger eases, once central banks or governments stabilize the shock, metal prices can retrace, and those who sold into the peak of fear captured real gains. So, when you evaluate selling, ask, has something fundamentally changed? Is the original reason for holding still valid? Is the real economic driver evolving? If the answer is no, you likely hold. If yes, it may be time to take profit or rebalance. Because at the end of the day, real-world triggers matter far more than round numbers, and smart investors respond to macro and personal realities, not price noise. When it comes to selling gold and silver, setting stop losses and partial profit targets isn't just smart. It's essential, because precious metals can rally hard, but they can reverse just as quickly. Right now, gold is trading around roughly $4,900 to $5,000 per ounce in global spot markets, and silver sits near the low to mid 80s per ounce range. Those price levels look impressive, but if you're only watching numbers without a structured exit strategy, you're exposing yourself to emotional decision making, the very thing that costs average investors money. So let's break this down in a way that's both methodical and practical, because your success isn't determined by luck, it's determined by process. First, partial profit targets. When you initiate a position in gold or silver, decide in advance where you want to take profit. Not all at once, but in stages. For example, if you buy gold at $3,000 per ounce and it reaches $4,500, that's a significant gain. Instead of waiting for an elusive all-time high or selling everything at one price, you might sell 25% or 33% of your holdings at that first target. Then you set a second target, maybe $5,200 or higher. Doing this allows you to lock in gains while still participating in future potential upside. The same strategy applies to silver. If you bought silver at $30 per ounce and it rallies to $80, that's a massive gain. Sell a portion there, let's say 30%, and then give the remainder room to run if silver continues toward $90 or even triple digits. The idea isn't to be timid, it's to be strategic and balanced. Next, let's talk about stop losses, and this is where discipline matters most. A stop loss is not a guess, it's a guardrail. It tells your broker to sell your position automatically if the price falls to a level that invalidates your thesis or exposes you to unacceptable risk. For example, if gold breaks below a critical support level, let's say down toward $4,600, that could signal a change in market structure. Without a stop loss in place, you might watch those gains evaporate as price slips. Silver, being more volatile, demands even more thoughtful rules. If silver were to break below $75 to $72 per ounce support on heavy volume, that could be your stop loss signal. Not just a gut feeling that it seems like it's going down. You want to anchor these levels in data, not emotion. Here's the beauty of combining partial targets with stop losses. You're managing both sides of the risk-reward equation. Partial profit-taking locks in gains as markets move in your favor. Stop losses protect you when markets move against you. Together, they keep your decisions tactical, not emotional. And remember, this isn't about selling at the highest point or avoiding every down move. It's about preserving capital, locking in gains, and staying disciplined, even when the market gets noisy. Because in precious metals, trends can flip fast. And when they do, you either have a plan or you are the plan's victim. So as you watch gold around $5,000 and silver in the 80s, ask yourself, where are my partial targets? Where is my stop loss? Am I selling based on a plan or panic? Sell with strategy, not sentiment. That's how real investors protect gains and thrive.